Hi, everyone. It's Larry Berman here, and this is not your weekly episode of Berman's Call. It's your weekly episode of the Investor's Guide to Thriving. Normally, my partner in crime, Jared, would be introducing us, and thanks to Air Canada's great schedule these days, he is on a flight and didn't make it. So um, what we have planned for you today is what we talked about all week in our social media and on BNN is my very special guest, David Rosenberg. Prior to David and I debating and discussing inflation and market bubbles, we're going to have our weekly sponsor, BMO Exchange Traded Funds, join us to talk about asset allocation ETFs. One of the things that David and I are going to discuss and debate, and David promises it's going to be very heated, is what I call the death of the 60-40 portfolio and the importance of fixed income in portfolios. So that promises to be very interesting as well. But before David and I take it away, I'd love to remind everybody that we do these things free of charge, and the way you can thank us is to help support one of the charitable causes, either cancer research at sick kids or dementia and Alzheimer's research at the Baycrest Hospital. For those of you who have made donations already, thank you very much. They will be matched by myself and ETF Capital Management. And for those of you yet to do so, we'll look forward to matching your donations. So up first is our first speaker tonight, and JC will join us from BMO Asset Management to discuss asset allocation ETFs. So JC, please take it away.
All right, terrific. Thank you. Thank you, Mr. Berman, and thank you to the team for the opportunity. Really appreciate it. So good evening, everyone. So I want to talk to you over the next 10-15 minutes about the power of asset allocation and about how asset allocation ETF have really simplified investing for Canadian investors. So what you're seeing on the screen here, just to begin, wanted to provide a quick overview of the Canadian ETF industry. That is for this year, 2021, as far as the growth and the direction of new cash flows that we're seeing in the industry this year. So we're on the verge of yet another record year in 2021. So ETFs are growing at a 30% clip the last few years. So it's really been incredible. So far in 2021, we've seen investors put in about $39 billion into the industry. As far as the breakdown of that cash infusion, if you will, most of it, 21 billion to be exact, has gone to equity ETFs, and about 8 billion has gone to fixed income ETFs. But what I really want to bring your attention to, however, is the 49.5% growth in new monies pouring into the multi-asset category. So if you look to the last column here towards the bottom, you'll see the 49.5% growth rate there. So that's mainly going into asset allocation ETFs. So that's a very impressive growth rate indeed. So if we move on to the next slide. So just to talk about what's been the main driver of that growth rate of asset allocation ETFs, well, certainly these ETFs have received a lot of positive media coverage, and the sort of the darlings of a lot of the popular bloggers out there. A lot of the financial journalists love talking about them, and a lot of the pundits also, have really showered a lot of praise on these ETFs. But also, I think meaningfully this year, the first asset allocation ETFs have reached the 3-year performance milestone, in 2021. And looking at the performance over the last 3 years, it's really been very strong, especially from a risk-adjusted standpoint. So a lot of investors have embraced these ETFs as really useful tools to help anchor their portfolios, if you will. So if we just move on to the next slide. So like I said here, these products, really fill the void in the marketplace and have strongly resonated with investors here in Canada. Since the first suite was launched in January 2018, the multi-asset category has really ballooned to over 14 billion in assets. So in 3 short years, 14 billion. So looking at who are the main players in the space, you can see them on the screen. Really, BMO, Vanguard, and iShares are the top 3 players in the space. And so you might ask, so what really are asset allocation ETFs? So essentially, just to make it simple here, they are a packaged portfolio. So it's an all-in-one, low-cost, globally diversified mix of stocks and bonds. And the beauty of that is asset allocation ETFs, they really take the guesswork out of building a proper portfolio. So they help investors invest in a way that is disciplined and that is appropriate for the risk profile. So most investors in Canada, or anywhere really, fall within 3 main risk profiles. That's conservative, balance, and growth. So these ETFs are constructed taking into account these risk-return profiles. So providing portfolios that are properly diversified across stocks, bonds, geographies, and sectors. So just looking at the screen here, for example, if you look at the first one to the left, ZCON, ZCON, that's the BMO conservative portfolio. So that really is appropriate for a conservative investor, just to make it simple. So it has an allocation of 60% to fixed income, to 40% to stocks. In the middle, ZBAL, that's the balance ETF. That has a 60-40 mix of stocks, bonds. And ZGROW to the right, that's the growth ETF, has an allocation of 80-20 to stocks and bonds. So all 3 ETFs have a diversified mix of Canadian, US, international, and emerging market stocks, as well as Canadian and US bonds. So if we quickly move on to the next slide. So how can asset allocation ETFs really help you as an investor? So as an investor, when you are thinking in terms of building an optimal portfolio for yourself, the best portfolios are really constructed on the basis of asset allocation, diversification, and rebalancing. So asset allocation together with diversification, that is a strategy of dividing your portfolio among various asset classes. So optimal diversification involves holding multiple instruments, and more importantly, instruments that are not positively correlated with each other. So asset allocation ETFs are designed to take that guesswork out of investing, as I mentioned earlier, by providing that prepackaged solutions that really checks the box on all these important considerations that an investor has to take into account, to ensure that he or she achieves long-term investment success. And so that is asset allocation ETFs provide 3 important elements. So number 1 is the global diversification across asset classes, countries, and sectors. Secondly, they are low cost. And third, they have automatic rebalancing. And if we move on to the next slide, so why are these ETFs so suitable for portfolio construction, you might ask? So just to elaborate a bit more on some of the benefits I already mentioned. So the automatic rebalancing ensures that the asset mix really remains consistent over time, and that's important, and we'll talk about it in a minute. The low portfolio cost is inclusive of the underlying ETFs, and research has shown that cost minimization is truly important for investment success in the long run because it allows you the ability to harness the power of compounding over time. So these ETFs are highly liquid and highly transparent. So mainly because they are made up of highly liquid core ETFs, and information on the underlying portfolio is updated on a daily basis and can be accessed on the BMO website at all times. So if you move on to the next slide, I want to talk a little bit here about asset allocation itself and why it's so important. So research has shown that asset allocation is the primary driver of performance variability of your portfolio. So what does that mean? That means that asset allocation is key to the volatility and overall performance of portfolios. So one of the most well-known studies in our industry, that's the Brinson, Hood, and Biebauer study that was done back in 1986. So they came to the conclusion that 91% of the volatility in the portfolio comes from the asset allocation decision. and not the actual security selection or market timing. And numerous other studies over the years from Ibbotson, from Morningstar, have confirmed these conclusions. So asset allocation, we often hear it's often referred to as the only free lunch in investing, given all the benefits. So just want to be careful here. So to be clear, the key fact is that asset allocation is essential to help lower risk and enhance returns. This is not necessarily saying you need to be passive. It is saying that your strategic asset allocation and not security selection is the key for most investors as a starting point. So it makes sense to use asset allocation ETFs to nail down the basics of your portfolios. So moving forward to the next slide. So I spoke about ZGROW earlier, which is a growth portfolio. So looking at the underlying portfolio of a ZGROW, the BMO growth portfolio, so it has an 80-20 allocation, as I mentioned earlier. So that 80% stock allocation is divided into 4 ETFs. So you have the US equity at 28%, call it, Canadian equity at 15%, international at 13%, and emerging market at 6%. And there's a 20% fixed income allocation, so that's covered by 3 ETF across Canadian aggregate bonds, Canadian government bonds, and US corporate bonds. So 7 underlying ETFs overall make up ZGROW. And it's same for the other ETFs as well, but the percentage will vary, across different risk profiles, of course. But I just want to make an important point here, however. So really the process of creating that strategic asset mix, on deciding on the geographic allocation, and on choosing the underlying ETFs, so that might look outwardly quite simple, but in fact, it really involves a lot of research. And what you see here really represents the best thinking from BMO strategists and our portfolio managers on what is the optimal mix, for a Canadian growth investor, to ensure investment success in the long run. So, so the point here is outwardly simple, but in fact, quite complex and really well thought out in terms of the work that goes into it. So moving on to the next slide. So I want to talk a little bit about portfolio rebalancing. So, we often hear that if asset allocation is the only free lunch, then rebalancing is the only free dessert, if you will. So the two really go hand in hand. That's the point here. And so in a 20-year study of the markets, so we've identified that rebalancing between asset classes, in a very disciplined way, can provide 6% more profit over time. And that could also further enhance the risk-reward ratio of a portfolio by a factor of about 19%. So the point here is any product that you look at, so when you're looking at those asset allocation ETFs or we're looking at other portfolios, really should have a clear ongoing rebalancing guidelines at little or no cost to you as the investor. So again, systematically rebalancing a portfolio, so that is to ensure the proper mix is maintained over time. We think is a really key element. And let's face it, most investors are unable to do it themselves because, it requires, constant monitoring of the portfolio. And more importantly, investors, have a hard time controlling their behavioral biases and will often buy at the wrong time or sell at the wrong time, right? So I think I'm guilty of it as well. So we're all guilty of it. So that was it for the benefits of rebalancing. So if we move on to the next slide, really wanted to highlight, a couple of ETFs here over the next 2 slides. So we know that BMO ETFs, have a long history of innovation in the industry. So we've taken the concept of asset allocation ETFs a bit further by introducing the first asset allocation ESG ETF in Canada. That is Zdsg here, as you see on the screen. So investors who want to apply an environmental, social, and governance screen to their investments can really do so with just the one-ticket portfolio solution. So making it really easy, if you want to align your values with your investments. So Zdsg constructed the same way as ZBAL, so it carries a 60-40 mix of stocks and bonds. So where it differs, and that's important here, is that the underlying equity and fixed income ETF holdings, so the 7 holdings, are all derived from BMO's leading suite of ESG ETFs. And these ESG ETFs utilize very strict standards to identify and invest in companies that are class leaders, for environmental, social, and governance in their respective sectors. So quickly here, so another innovative take on the asset allocation concept is ZMI. So if we go to the next slide. So that's the BMO Monthly Income ETF. That's an ETF portfolio designed for investors who have certain income obligations. So ZMI includes higher yielding BMO ETFs as the underlying holdings. So the emphasis here is on yield and on income, but overall focus remains on, again, global diversification across stocks, bonds, sectors, and geographies. So the balance of the mix here is 55% stocks, 35% bonds, and 10% hybrid solutions. So like preferred shares and covered call ETFs. And just a quick note here, we did reduce the management fee on this mandate to 18 basis points last month. So just to conclude here, if we go to the last slide. So just to conclude, my part of the presentation, really want to invite you to check out the Market Insights webinar. So that's hosted by us, BMO, and the TSX every Friday at 1 p.m. Eastern Time. So we try to bring you our best thinking on the markets and investment themes. So our next one tomorrow will be on the topic of autonomous technology. So that's every Friday at 1 p.m. To register, very simple, go to etfmarketinsights.com, and you can also stream past webinars that we have posted on the site as well. So with that, I think I've exhausted my time. I wish to thank you all for your time this evening, and I'll pass it over to Mr. Berman. Thank you.
Thanks so much, JC. And so part of the debate tonight with our upcoming guest is going to be looking at the 60-40 portfolio. And I should say I love these BMO ETFs. I've talked about them for years, since the day they came out. For under 20 basis points, you really have, for the average investor, a great solution. The issue that I have is the yield that you're getting off fixed income and what that might mean going forward. So, I'm going to introduce our first guest now, and if I can ask Rosie to get his camera going and his mic going, that would be terrific. There we go. I see him. So from Toronto to London to Berlin to Frankfurt, no, it wouldn't be Berlin, it would be Frankfurt, to Mumbai, to Beijing, to Tokyo, all the way back to New York. This is one of the few people in the investment industry that has one name. It's Rosie. Everybody knows Rosie. So welcome, David. Really excited to have you here. This is going to be an exciting hour plus of going back and talking about a bunch of different things tonight. Focus really here being inflation. This is probably one of the most important investment issues that we probably have had to deal with in decades. So we're going to go through that. I want to talk about that 60-40 portfolio and get some of your views there, and we'll talk about asset bubbles and China and earnings and your best picks list and what might work for the next part of the investment cycle. So coming up. So welcome, David. Welcome, Rosie.
Just not rosy scenario.
Just not a rosy scenario. Fair enough. So let's get right into it. First thing I picked off the wires this week was the B of A Global Fund Manager Survey, and they go on a month-over-month basis. And basically, in October versus September, what are the biggest tail risks to the market? What tail risk is what people aren't prepared for, and the number one biggest thing here is inflation, and it continues to increase. China is something people are not ready for. All of a sudden, apparently, China is not investable. We'll get into that. Asset bubbles, there's more of that, but have a note there that asset bubbles are less important this month than next. So that might bring up the idea of complacency, and maybe we could talk about that. Fed tapering and Fed policy, what we heard from the Bank of Canada this week, an abrupt stop to to QE, a bit on COVID and fiscal policy, and so let's get right into it. You want to start us off here on your thoughts on inflation, and is it transitory? What's driving the bus here, and what do investors need to know?
Well, I think you asked the question, is it transitory or sticky? I'm going to sound like the traditional economist and say the answer is yes to both.
There's a hedge. I smell a hedge coming.
It's firstly, in terms of the stickiness, we have to understand that the real root of the inflation, like you can go and talk about quantitative easing and the money supply, but people have done that for the past 20 years and gotten it wrong, because the velocity of money, which is correlated with the extent of the debt burden in the economy, and this is global, it's not just in the US or Canada, money velocity has been going down structurally. So, the Fed may have overstepped their boundaries, but they were fixing a leaky boat. People that talk to me about the money supply, you can't talk about the money supply, without talking about money velocity. That's just the classic Fisherian identity of MV equals PY, the quantity theory of money. That's basic economics 101. And then on top of that, people talk about a wage explosion, which is really confined in 20% of the market, which is in people aged 16 to 24, unskilled, uneducated. This is what they call the revenge of the nerds. But despite, what you read in the papers and the people you see on Bubble Vision, there's been no broad-based breakout in wages. There's just been a lot of narrative about it. But you can't talk about wage growth without talking about productivity, because it's unit labor costs. That's the mother's milk of inflation. So money velocity continues to act as an antidote to the money supply. Productivity growth has actually been accelerating. And so if you have wages going up 4% and productivity is going up 3%, unit labor costs are running at 1%. It's not inflationary, but everybody's got inflation on the mind because we have this massive global supply squeeze going on. The bottlenecks, as they're called, the massive constraints that you're seeing, especially on the material side. So that's basically a result of the pandemic, and really nothing else. I guess you can argue about underinvestment in fossil fuels and traditional commodities, but that was true in the last cycle. The underinvestment in commodities was true when everybody was going wild over ESG and we're never going to need fossil fuels again. That's not a new story. It's really about the pandemic, the shortages, especially coming out of supply chains in Asia, where the vaccination rates have been rising more slowly than they have, say, in most parts of Europe and in North America. So if you believe that we'll get through the pandemic in the name of consistency, you have to believe that, and it might be with a lag, we're going to get through these bottleneck issues, because it doesn't make sense to say, oh, well, we're going to have a reopening of the global economy, but the supply side is not going to come back. Of course, the supply side is going to come back, and it's probably going to take several more months or quarters. But when it comes down to this word transitory, what does transitory mean? There's nobody that ever says transitory is days, weeks, months, or even quarters. It just basically means short term, not permanent. And so, yeah, I'm in that camp. It's the camp that's being ridiculed right now because people can't see past the tip of their nose, and they extrapolate today's price experience to what's going to happen 1, 2, 3 years down the road. And I think that's a dangerous proposition to be making, any more than when the front month contract on WTI went negative for a day back in the winter of 2020, and commodity prices were diving, and we had a few months of deflation. As with the benefit of hindsight, did you want to superimpose a deflation view in the winter and spring of 2020 into the future? And we have to recognize that this is a one in a century event, a global pandemic. It's wreaked havoc on the world economy. It's wreaked havoc on government policy, and it's wreaked havoc, of course, on inflation. But the answer to the question is that I do believe it's transitory. I'm not going to allow anybody to pinpoint me into what that means. Does it mean months or quarters? Because, well, it's ridiculous to even ask the question because nobody knows. We're still in the context of a global pandemic. It's encouraging to see the case counts coming down, but we're in a bog of uncertainty. And I can't believe how many people are talking about hyperinflation, stagflation. Most people can't even define what these terms are, but they'll go on CNBC or they'll go on Bloomberg TV and they'll just pontificate. And my point is that the supply bottlenecks and the shortages will ease. It may take another year. The central banks are saying, yes, sure. The Fed, you mentioned, Tiff Macklem. Yeah, it's taking longer than people expected. Then again, we did have the Delta variant. It caused, more problems. I think that, there are commodity cycles. We've had probably 13 commodity cycles since 1950. Commodities don't create the conditions for enduring inflation. The labor market, though, and remember I talked about unit labor costs, so we'll put productivity aside, but if wages were to really accelerate beyond productivity, I will be full square in the inflation camp. I'm not seeing it yet. I know that might be a forecast for some people. Interesting enough, the pandemic forced businesses to automate. I mean, it's interesting to me that in 2020, the worst year for the economy since 1946, the strongest component of GDP was business spending on software, intellectual property. Automation was up 7% in volume terms, which is incredible. So I'm actually starting to see a shift in the capital labor ratio that is not really inflationary. Companies, if they can't find the labor, will simply automate. But for the near term, that's really the elephant in the room. Have we hit somehow, did the pandemic cause such a fundamental shift in the labor force that we've hit a supply wall of labor? And I don't know how these people, millions of people, aren't going to go back to work. You hear people are retiring early. Really, well, the thing is that, you look at the life expectancy table, and you don't realize if you're retiring at 60, you're going to live another 25 years. How are you going to make that dollar stretch beyond just basically trading GameStop and AMC, and Bitcoin? People will have to come back to work. Of course, the government ended up giving people a lot of money and the extended jobless benefits, but that to me is not an enduring feature of the economy. Now, if we go to that situation where there's going to continue to be stimulus checks and more government spending to ensure that people can just sit at home and do nothing, well, my call on inflation is going to be in trouble. So a lot of this comes down to the labor market, but we don't really know. You look at the United States, it was only in September that these extended, very generous jobless benefits where you didn't have to work and you probably made more money not working than in your previous job. But that's only been out of the system for about a month. We have to give it time. But I think this is the frustrating thing for central bankers and even for myself, who are expecting the participation rate to come back with the reopening of the economy. That hasn't happened. And I'd say that, if you're going to look at me and say, Rosie, you changed your call and you became an inflationist, it's going to be, my answer will be, the participation rate's not coming back. The full unemployment rate, what they call NAIRU, full employment, which in the last cycle was 3.5%. Well, maybe now it's 5.5%. You see, it's going to be learning by doing. There's a lot that we don't know right now, but the real key is not about transportation rates, and it's not about what copper and aluminum and nickel are doing. It's such a small share. Even oil. I mean, oil is. You look at the economy. Oil is 70% less important for the economy than it was in the 1970s. I'm not saying it's not important. It's just less important as a share of the economy because we become over time much more service oriented. The good side of the economy is only 13% of GDP. 5 decades ago it was almost half. So, I'm not impressed with people talking about, oh, did you see what paper packaging prices are doing? Okay, I get it. It's really going to come down to what's happening in the labor market. And that's what I'm focused on, first and foremost. My expectation is that, let's just look at it logically. Okay, Larry. How many people are going to be able to not work? How many people will be able to not go back to work? They'll have to go back to work, or how will you feed your family? And you can't have it both ways, because if you're choosing to take an income cut by staying at home, maybe you're living off your savings. You can only do that for so long. If you're going to choose to take an income cut by choosing not to go to work, and that obviously has supply side repercussions. It makes it a more inflationary supply curve for the economy. But what about the demand side? Are you going to be spending the same? If you're not working and making a paycheck, Are you going to be spending, your spending patterns, will they remain the same? And of course, it's ridiculous to say that they will. So there's going to be a simultaneous impact on the supply curve and on the demand curve. I know I'm sounding like an economics 101 professor, but it's not clear to me. And actually, right now, I'm enjoying myself because I'm seeing everybody flock to the inflation camp. And I'm very comfortable in saying that I can see it for this year. I can see it for several more months or quarters because there is a transition going on here, a price level transition related to the pandemic. But if we're going to say move beyond 2022 and into the next 3-5 years, are we talking about a whole inflationary cycle? Let's talk about a cycle. Are we going into a whole inflationary cycle? I just don't see it. And I think people who take today's price action premised on the first global pandemic in over a century, and you're making decisions based on that, big mistake.
So, you know, you think the big comparison is the 1970s and the differences between today and the 1970s. We put out a job posting for a portfolio manager that we were looking for. I think we got 200 resumes within a week, right? So there are surplus labor, obviously, in some industries. But I talked to a friend of mine who has a manufacturing business and needs people to work on the line, and he can't find them. So I think it's the mix maybe on the labor side, but you know, from the 70s and from the strength of the labor unions, it's a very different world than it is today. And if we start to see that labor union and wage settlements really start to step up, do you think that changes your thinking a little bit?
Well, look, I mean, I guess this is always a situation where your assumptions will drive your conclusions. Firstly, the 1970s. 1970s, we did not have a global pandemic. We have a global pandemic, or we had. So why compare to the 1970s? The 1970s, we were much more oil dependent. Oil as a share of the economy was far greater, 3 times greater than it is today. And we didn't have one shock. Like we basically, now you could say that, yeah, we've got a climate change shock, and certainly that's affected agriculture prices. You could say underinvestment in fossil fuels. We already knew that for years. That's not a new story. OPEC has just decided to, OPEC Plus has decided to be very stringent. Well, we had that, if you remember, back in, call it 2011, 2012, oil went back up to $100. And we all know as Canadians what happened in 2014 and 15 when they had the trap door open up. So who knows what oil is going to do? Everybody was waiting for OPEC Plus to do something at the last meeting, and they didn't. Okay, so a lot of people think oil is going to go higher, and it probably will, but it's a lesser share of the economy. Oil in the 1970s, oil price in the 1970s went up 11-fold. 11-fold. And there were 16 price shocks in the 1970s. There wasn't one. 16 different times that oil ratcheted up, and it went up 11-fold. And so to compare what's happening now in the context of a global pandemic that has certainly seized up global supply chains, oil prices ratcheted up every year through the 1970s. Are we going to have a global pandemic every year, do you think? Are we going to have every year with global semiconductor facilities shutting down? Or will they actually be more investment? So the 1970s is basically, to me, a real false presumption to be using that as a benchmark. But let me just go back and talk about, you know, your comment about unions. Let's see how that unfolds. You know, so Starbucks, Amazon, you're seeing a lot of headlines. We'll see if labor power really comes back with a lot of force. Let's see what happens. You see, the problem is that, and I adhere to Bob Farrell's 10 market rules to remember, there are no new eras. Excesses are never permanent. And I gotta say to my client base over and over again, There are no new eras, especially in the United States, and that's because it is a 2-year political cycle. Everybody thought when Bill Clinton, from Hope, Arkansas, gets elected in 1992, and everybody thinks there's a whole new era. They thought this that this governor from Arkansas was going to unleash some form of socialism, and his wife is taking up an office in the White House and planning a whole revamp of healthcare, which we got decades later. But let's be serious. In 1994, the Congress flips to the Republicans, and there is no big Clinton shift to the left. In fact, with Bob Rubin, he shifted to the right. But Bill Clinton in his last term did things in terms of capitalism that you never would have thought when he was governor of Arkansas. Well, go figure that. Would you really what were you thinking about, Larry, in 1992 when Bill Clinton got elected? Or let's just say Barack Obama. Wow, talk about transformational. 2008. And here is supposedly another socialist from Chicago. And he did get Obamacare through, and that was it. In his last 6 years, he was a lame duck president, using executive order. Nothing got done in Congress, except we had the Tea Party exercising its role in fiscal restraint. So think about that. Think about Donald Trump. You want to talk about inflation. I guess I'm just too old, and I've just basically been through too many cycles. And I know that people want to believe in inflation. People want to believe in inflation. People want to believe in rising bond yields because it somehow makes them feel better. It ratifies their view that the economy is good. You get pricing power, you get inflation, rising rates. It's good. And the reality is that there are fundamental reasons why that isn't happening. And who ushered in the greatest potential for inflation was Donald Trump. How can you deny it? I mean, I remember after he got elected, Larry Lindsey, who was governor in the Federal Reserve during the Greenspan era, was on CNBC talking about the future of inflation and that bond yields are going to 6%. This is one of the smartest economists in the United States. So what happened? I mean, we had Donald Trump, and all people talked about was nationalism, isolationism, protectionism. If you remember the unions, Larry, the unions supported Trump, and they abandoned Hillary Clinton. And so what does Trump do? Trade barriers, tariffs. He built a wall around America from an immigration labor standpoint. So we get the unemployment rate down to 3.5%. He constricted, people talk about labor supply. Well, we had the unemployment rate through Trump's policies, and it wasn't just through demand, but he built an immigrant wall around labor. I could not have gotten the job I had at Merrill Lynch in New York on the H-1B visa I had at Merrill Lynch from 02 to 09. I could never have gotten that job out of Toronto to New York when he was president. He built so we had all that. We had labor supply constraints under Trump. We had tariffs, and he cuts taxes by $1 trillion at a time of a 3.5% unemployment rate. And we finished the Trump cycle with a 3.5% unemployment rate, the lowest in 50 years. But inflation was 2%, wages were 3%, bond yields were 2%, and this is all before COVID. And this was all under Donald Trump, who, by the way, people, now I got to say, people were not talking about hyperinflation. I mean, I don't know, the CEO of Twitter, I don't know what economic model he has. I can only say he doesn't know what he's talking about. Nobody was talking about hyperinflation. And I don't think anybody was talking about stagflation because, of course, he was deregulating. But Larry, come on. 2017, 2018, inflation. It was all about Trump-led inflation. And when you think about it, why didn't it happen? You had the perfect conditions for. I think actually you had greater conditions under Trump for sustained inflation than what you have today, which to me is actually transitory, however defined. It is basically a price level distortion, massively to the upside, but I don't think sustainable. You had actually better conditions with Trump to get inflation under his policies, and it didn't happen because of the 3 Ds. Excessive debt. Debt is a stranglehold, a tourniquet on aggregate demand. And that's why when people say to me, how did we have endless quantitative easing under Bernanke, 0% interest rates for 8 years, massive infrastructure spending from Obama, and then the other bookend, massive tax cuts by Trump, tariffs up the wazoo. We had the perfect conditions for inflation. Well, And it was yet with all the stimulus that we had, all the stimulus, how did 2009, 2019 turn out to be? It was a long expansion, weakest economic expansion. We had stronger years in the 1930s during the Great Depression than we had from 09 to 2019. That includes Obama's years and Trump's years. And it's because we have too much debt and we're choking on it. And now post-pandemic, we have more debt. We have disruptive technology, which is ongoing. And people who talk about wages like you just did and unions, but nobody ever talks about productivity. I always wonder about that. People only talk about one side of the supply curve. They talk about wages, they don't talk about productivity. How can you actually have an inflation model? Okay, beyond the distortions, and these are huge distortions right now. Let's just say huge distortions, but if you're gonna have a real inflation view, a secular view, you better have a view on productivity. You wanna talk about the 1970s, Larry? Yes, indeed. Unions created the conditions for 10% annual growth in wages. But productivity was 1%. It was actually almost zero. You had a totally sclerotic economy from a productivity standpoint. And now productivity in the non-financial business sector, because I actually make my living looking and analyzing data, is running close to 3%. So tell me, when you talk about inflation, what's your productivity? What is your productivity view? But in any event, let's going back, I can understand the it's not hyperinflation, it's hyperbole. But I heard it, like I said, I've been around too many cycles. We had the conditions and we had the narrative on inflation with Donald Trump. Didn't happen because of excessive debt, disruptive technology, and demographics. Aging demographics is hugely disinflationary. Just look at the two countries of the world that have the oldest demographic characteristics. Japan and China have the lowest inflation rates. You know what, Larry, if we were filming this in Tokyo and we talked about inflation in Japan, they'd be laughing at us. Okay. If we actually right now did this, and maybe we'll have to learn some Mandarin, and we did a talk, because inflation is close to zero in China. China's economy is stagnant. If we actually had this conversation, Larry, in Beijing right now, they'd be a laughing stock. Okay. And they have the oldest demographics. So I'm just saying these are powerful secular trends. All right. And I'm going to say this. I will give a forecast that I believe is 100%, as close to 100%, is that in a year's time, we will not be talking about inflation anymore. Okay, this will be as passe as it was when we talked about Trump-led inflation, which never materialized either. There's too many structural forces mitigating sustainable inflation. Now, people think it's a joke. Transitory is a big joke. You know, I was at the gym the other day, and actually one of the trainers there said to me, because he saw a piece I wrote on the National Post, he says, he laughed at me, a trainer. He says, you're like on the transitory side. And I said, yeah, you know, it's true, but I don't have leprosy. So don't worry, okay? It'll be okay.
So inequality, something you and I are both quite passionate about as a structural challenge to a strong economy. Is trying to fix inequality by bigger government, is that inflationary? Is there anything there to increase labor share of income that policy can drive to be inflationary?
Well, look, I think that it's a little problematic, but the only way you could really do that effectively is through the tax system.
Okay, so part of Biden's plan today, they want to tax share buybacks. If you caught that, they wanted to put a 1% tax. So if the corporations profit, instead of giving it back to the shareholders or investing in capital and new employees and jobs, they're going to buy back shares. They want to start to tax that. Are policies like that going to pick up inflation at all?
No. It's all for show. It's like you know, the Liberals in Ottawa taxing you know, luxury boats above a certain level. It's just for show. You know, this is what happened to the Democratic Party in the 90s with Clinton, when Clinton shifted from the left to the right. And you know, he ended up cutting capital gains taxes, you know, cutting dividend tax rates. And so I think that, you know, and I'm not going to be a big advocate here for higher corporate tax rates, but what I'm saying is that if income inequality is a problem, taxation policy and maybe what you have to do is ultimately and I'm going to sound like a quasi-socialist here, maybe full socialist. You can do that through moving to a UBI, Universal Basic Income, which is basically a glorified version of welfare, but they have that in Europe. You can't have it both ways, Larry, in the sense that, America is special because it always has a premium on its assets, because it is the Wild West. And when you have the Wild West, you're going to have a lot more people at the bottom that are being left out, which doesn't exist in other countries. But when you're taking a look at return on assets over time, the United States stands out because it is the really the poster child of free enterprise. So if you're talking to me about the problem of income inequality and capital versus labor, well, you can really do that through the taxation side. And I guess that would mean that you raise tax rates on capital, and then you lower them on labor. But then within labor, because the income inequality isn't really between capital and labor when you really think about it, it's within the personal sector. Because when you're taxing a corporation, it's double taxation. I mean, a corporation is a collection of individuals in an entity, and you're taxing everybody's income who works as a worker, and then you're taxing the company at the corporate level. So if your worry, which is not my worry, is capital versus labor, I'm not worried about that. But if you think that's a worry, then you can do that through taxing capital, reducing taxes on labor. The real problem with the inequality is not capital and labor. It's really within the labor market itself. It's really about, you could argue in many countries, the lack of progressivity in the tax system. So how do you accomplish that? Well, you cut tax rates for low and middle income classes, and you fund that, because unless you want to run gaping deficits, by raising tax rates for higher income individuals. And however you want to define that higher income. Now look how it's gone in the States, where we're talking about taxing billionaires. Well, there's just not that many that you can tax that's going to make a very big difference. And this is actually, look, this is what FDR did, before World War II to fight the Great Depression. Because, he never ran, FDR, tip your hat to him, he never ran a deficit over 7% of GDP. I mean, what do we have here? Like 15, 20% deficit GDP ratios. FDR never ran a deficit over 7% of GDP. And by the late 1930s, before World War II, they were back in a balanced budget because he did exactly what you were talking about. He raised taxes on the upper echelons. He had $1 million, back when $1 million meant something, he had a millionaire's tax. And what's interesting is that there was no pushback. In the context of the sort of economy we had in the 1930s, to be complaining about higher tax rates at a higher income level would be like wearing a red dress to a funeral. People didn't argue about that. People didn't argue about that back then. But but society, and especially in the United States, not so much in Canada, but in the U.S., it's so polarized and so divisive. And the word tax is a dirty three-letter word. And this is what Biden is figuring out, right now. But that actually is what you would want to do. You'd want to have a big income tax cut for middle income, low income households, and you have to raise taxes. And raising taxes for higher income individuals, they're not going to be happy about it, but it's not going to influence their lives as much as the tax cuts and the income boost you're going to give to people that actually spend most of their income to begin with.
Ultimately would make for a healthier economy, more broaden it out, right?
Right. I totally agree with that. And this is why, by the way, when you think about why did Hillary Clinton, why did the Democrats actually ensure that Hillary didn't get elected in 2016? Because the Democrats didn't show up. And, we can talk about different reasons why she was vilified as much as she was, but a lot of it was because they pushed the party too far to the right. And now, of course, the progressives and Biden are pushing it, and Bernie Sanders, this pendulum swinging the other way. But that was the big problem. The big problem is that here you had the president from Hope, Arkansas, talking about income inequality. Look how many years ago that was, Larry. That was like 30 years ago. Yeah. And actually, income inequality, well, it kept on widening out, but it widened exceptionally under the Bill Clinton years.
It did. It's been decades in the making. So another chart here talking about growth. So, you know, they talk about this strong economy we have, and to me, if you balance the budget, we'd be in such a massive recession. Can we ever get out of this debt trap? I mean, growth weakens. The Fed is now talking about tapering. They're just going to have to step on the gas again. We're going to need more spending and more stimulus. I mean, that, to me, that's the world we live in. And so we get these bursts of growth, but really underlying it, it's weakness. And I know you've made this point quite a bit in your daily research, which I've been reading forever and ever. Even when I wasn't allowed to read it, when I worked at another bank, it's like, anybody got Rosie's piece? I got to read what he's saying right now. So, you know, I've always been a huge fan of your work, but, you know, so that I'm in the transitory camp from everything you say, in that structurally this is not a problem. I think it's going to be more sticky, maybe even a couple of years here. But again, that's a definition of timing more than anything else. What you've commented on recently is the weakening economy. So do we have this fiscal cliff coming? Is the spending the Congress that wants to do, is this enough? Is the Fed really going to be able to taper here, or they're just going to have to step on the gas, kind of like what happened in 2018, where they had to do an about face?
Well, look, let's start with the last question first. So it seems to me as though the Fed is going to taper, and I'm only saying that because they've told us that. And you know, we're just a few days away, you know, from the next FOMC meeting. So they'd be very foolish to not at least, I don't know if they will start the taper right away, but to not announce it maybe for the December meeting. I expect that's what they will do. I don't think that the economy will be strong enough for them to raise rates. Certainly not in the timeline that the market's got priced in right now, and even more aggressively in Canada. So I don't think that the economy will give them the latitude to raise rates. Again, I think they would like to raise rates. They like to think they could raise rates. I'm not so sure. I think the economy is going to be very weak next year. Now, if we get a big fiscal stimulus in the United States, then maybe that will create the conditions where demand is strong. As you said, the supply conditions that we have right now linger, and they'll have to get ahead of inflation that proves to be more persistent. My assumption is that nothing's getting done in Washington. The Democrats are as disunited as the Republicans are, but that's where the rubber meets the road on fiscal policy. And the progressives have said, if we don't get both the physical infrastructure and the human infrastructure, we don't get that done all at once, then it's all or nothing. I can't believe that they didn't at least go for the physical infrastructure first, but they realized there's a midterm election next year. So it's just like Barack Obama knew he had to get Obamacare done in his first 2 years, and he did. It's just like, you know, Trump knew he had to get tax cuts done in his first 2 years, and he did. And the Democrats see the writing on the wall, because they're probably, you know, unless Trump manages to really screw things up for the Republicans next year, it's good. I think both the House and the Senate are probably going to flip. And that's what I'm talking about, is that it's a 2-year political cycle in the United States. It's got its benefits because it's a real check and balance, but it's hard to get anything done from a secular standpoint. You know, people were saying the same thing, Larry. People were saying the same thing about, are we getting more stimulus out of Obama? We had that first the Reconstruction Recovery Act, and that in today's dollars was $1 trillion, back when $1 trillion really meant something. But he never got anything else done, right? It got Obamacare, but there was never any more stimulus after that. So, you know, what's the outlook beyond next year? My assumption is that nothing's getting done in Washington, and then we'll have to wait till next year. This will become a political issue. Maybe we'll get a slimmed down version, or maybe we'll get the physical infrastructure. But let's even say we get the physical infrastructure, $1.5 trillion. Capitalized over 10 years. Is that going to get you super excited, Larry? $150 billion a year in a $20 trillion economy is not going to spin the dial on the business cycle. But it doesn't mean that the U.S. doesn't need it. They certainly need physical infrastructure. It's amazing it has been done. But I would not be making a bet on inflation and interest rates and the economy. I mean, the biggest infrastructure package of all time outside of FDR in the 1930s was Eisenhower's rolling out of the creation of the interstate highway was all Eisenhower, and he passes that in 1956. And then we had 2 recessions separated 3 years
well,
apart.
you talked about money velocity.
So what I'm trying to say is that, the fiscal side, I'll tell you, Larry, if nothing gets done, because what else is there? Like, somebody's got to come and tell me, what is the vitality in the economy? What is it? Okay, we have reopening. Yep, we have reopening. People going back to Disney. That's great. 3% of the economy are restaurants, movie theater, all the stuff people talk about. Hotels.
Not part of the economy.
It's 3% of GDP. So, but I know, but it's very visible and it's fun. But I mean, it's not going to have a massive impact. We have the reopening. We got the vaccines. The COVID cases are coming down, and we have stimulus checks. And so, where else is the vitality coming from? We just got the GDP numbers today, Larry. What do they tell you? Real final sales negative 0.1. And real GDP 2% only because of inventories, but real demand was actually, call it, flat. And this is what's happened with fiscal policy, is that it's created a boom bust economy. There's no multiplier. You see, this is the problem with this type of fiscal policy, is there's no multiplier impact. It gives you a sugar high in one quarter. We get 6.7% in second quarter. Next thing you know, we're almost flat in the third quarter. And so, but it's been so powerful. Look, the level of GDP, people have to understand, the level of GDP today without all the fiscal stimulus would be 5% lower than it is. Where would we be? And without the Fed, by the way, the stock market would be 20% lower. And I guess we'll talk about that. But let's just say that next year, the numbers that we're putting through our models are saying that fiscal policy, the fiscal drag, now it's not a cliff, but it's a pretty steep hill. That remember that GDP growth, it's a flow. It's not a stock variable. And the lack of fiscal stimulus next year compared to this year is going to be a 2.5 percentage point drag on GDP growth. So if your starting point is, say, roughly, let's average out the second half of the year is around 3%. You're talking about a flat year next year for US GDP. I'm seeing that consensus views are 5%. The Fed is like basically 4%. I actually think next year is going to be close to flat. And I love it because I have a view that I can back up that is differentiated from the consensus and differentiated from what the rates market have got priced in right now. So next year's going to be a very exciting year from that perspective.
Today, we saw the 30-20 part of the US yield curve invert. So we're just starting to see the back end of the curve supporting your view here that inflation isn't an issue, and now we're worried about slowing economic output.
Well, that's a great point. There's 2 yield curves right now. There's the yield curve from, say, 2 years to 5 years that has steepened a lot. Why? Why is that steepened? Because the market's pricing in more Fed tightening. The same thing in Canada. But you look at 5s to 30s, 10s to 30s, you mentioned 20, 30s, the curve out 5 years is flattened like crazy. In fact, in my daily today, I had the chart of the 530 spread, which I think has gone down below 90 basis points. It's the flattest it's been since March 2020. So you see that part of the curve is telling you, one part of the curve, the front end of the curve is telling you the Fed, the central banks are going to start to raise rates very quickly and go further than anybody thought a couple of months ago. And the curve at the back end is saying they're going to make a policy mistake. And it's very fascinating how one market, the treasury market, could tell you 2 different stories, but it's not opposing stories. Of course, the Fed's going to make a policy mistake. And in actuality, 75% of all the 75% of all the Fed tightening cycles that we've had since 1950 have landed the economy in a recession. It's funny that you bring up the yield curve, because do you remember in late 2018, when Jay Powell was flexing his muscles, of course he was facing that Trump tweet machine all the time. The yield curve inverted. Remember, Larry? And everybody was saying, forget the yield curve. It's immaterial. Forget the yield curve. But what's interesting is that before COVID, the U.S. economy was actually weakening precipitously. People tend to forget that. Why did Powell cut rates 3 times in 2019? Why did the Fed revamp its balance sheet in the second half of the year? Because they saw the whites of the eyes. Guess what? The economy may have slipped into recession, even without COVID. What do you know, right on time? 4 to 5 quarters after the yield curve inverted in late 2018. And here, once again, as you said, we're talking about parts of the curve that are already flattening or inverting. And that's valuable information. It actually tells you that the only way we avert a recession is if the Fed doesn't do anything. The Fed does something, and they're saying they're going to do something. And that's you can build a whole investment thesis out of that alone, out of those 2 yield curves right across the spectrum.
You put this chart in your package today, which basically adjusted the Fed funds rate and added QE as a variable in terms of what the effective interest rates are. And your chart here is showing the effective interest rates, so including 0 interest rates on Fed funds and the negative impact of QE, that we've got 10%, negative 10% interest rates. You know, and in the last cycle, end of 2019 there, as you can see before COVID, you're talking about the tightening. We didn't even get back to positive. Right? Right?
It's
And
incredible.
that's how weak the economy is. We need this stimulus, and what a headwind all this debt is.
Well, that's what I mean. You know, the fiscal policy has certainly had impacts on the real economy. And there's just no multiplier impact. Well, like I said, you get the big Biden package in second quarter. You got 6.7% growth. The stimulus fades. Oops, we're down to 2 on real GDP, negative 0.1 on real final sales. It's just a boom bust. And now people are clamoring for more fiscal stimulus. Well, the fiscal certainly has an impact on GDP, but you see there's no multiplier impact because of the nature of these sorts of policies. They're not improving. You see, they are not improving the productive capital stock of the economy. That's the problem with these.
They're just
with
boosting asset
Biden
valuations.
stimulus. It's a temp. Oh, you want to talk about transitory, Larry? The sugar high from these types of stimulus, that is, and it creates tremendous volatility in the data. But you see, the Fed has no impact on the real economy. You know, in the old days, when you want to get the economy going, they cut rates 500 basis points. And so housing became more affordable, and you can go out and get a loan and go buy a car. The credit sensitive sectors would accelerate, draw down inventories. You go back to the next positive cycle. We went into this cycle with the funds rate at 175. How could they cut rates 500 basis points? I was writing back in 2018, the business cycle isn't dead. We're going to have a recession at some point, and the starting point is $1.75 and the funds rate. What do you do for an encore? Because do you remember in the previous cycle, the funds rate got to 5%, and they realized, well, we went down 5 percentage points. We can't go below 0. Bernanke says, oh, guess what? I have a magic wand called quantitative easing. And it's basically a surreptitious way through our balance sheet to invoke a theoretical construct where interest rates actually go negative, although they're not going negative, because God forbid, if you went to negative rates outright in the US, you would destroy the money market fund industry, which the corporate commercial paper market relies on for funding the corporate sector. So they couldn't do that. No. So Bernanke, the genius, the academic genius, QE is a way to create a synthetic negative interest rate. And as you can see, exactly right. And then this time around, because we'll look at the Feds, they went down, so you go back down to 0. They didn't go negative, but they took the balance sheet up so dramatically that the de facto funds rate is negative 10%. And actually, you can look at this, and people will say to me, boy, you just should have had 100% in equities. How could you look at that chart and not say, but be 100% in equities? And I guess the people would say, I would say to them, you're 100% right. How could you look at that chart? Because the Fed's actions only affect financial asset inflation. The Fed has been your best friend. If your cyclical assets, credit, or equities, look at this chart. Look at this chart. How do you even do any fundamental analysis? Look at what the Fed has done. I mean, if you're looking at this chart, you'd be thinking that the price earnings multiple should be Jack and the Beanstalk. I mean, look at what the Fed has done. And of course, people talk about FOMO, fear of missing out, TINA, there's no alternative. These crazy, very dangerous acronyms, which nobody will ever find. You know, in the Don and Graham classic textbook on value investing, you're not going to find these acronyms. But it is rather incredible because when you look at that de facto negative interest rate, how do you do any fundamental analysis on discounted cash flows? And that's what the Fed has done. The
Yeah.
Fed and these other central banks have totally distorted the ability to
Okay.
effectively price risk assets.
You're making my point, and this is why I say it's the death of the traditional 60-40 portfolio, because Harry Markowitz and Bill Sharp won the Nobel Prize for telling us how to build a portfolio with the optimum amount of risk relative to our expected return. And we thank them all for that work. But now you have two asset classes, equities that have the lowest earnings yield and dividend yield that we've ever had, and fixed income that basically is the same. So your guaranteed return or your easy return from a 60-40 portfolio after inflationary pressures, and again, we've debated the transitory nature, but you've got now two asset classes that don't yield you anything on a real basis. So this bubble theoretically has never been bigger. And my contention here in saying that the 60-40 is dead is the ballast, historical ballast of this Nobel Prize winning work was that the income from bonds would stabilize your portfolio from a volatility perspective. Duration has never been bigger. So here's an asset class that mom and pop, as they retire and hit 65 and beyond, should have more of to stabilize their portfolios, but now they don't get the income they can live off of. And that's my point in saying it's broken. So what's your point here in saying that this is not broken? I really want to get to the meat of this.
Well, this is under the proviso of how central banks have distorted the risk asset pricing and really just almost destroyed the equity risk premium. And we don't know if that's going to be a permanent feature of the market. It's certainly been around with us for quite a long time. When I started in the business in the 80s, we didn't talk nearly as much about central banks as we do today. We certainly didn't talk about, nobody ever said the Fed has your back. That's rather incredible that we have that mindset. The 60-40, I guess what I would say is this. You're quite right. I mean, you're taking a look. People talk about forward multiples, and they take a look at 1 year multiples. For a S&P 500 has a duration of 50 years, and people look at 1 year forward, theoretically very sloppy. I look at the CAPE, the 10-year Shiller PE multiple is 38 right now. This is a 3 standard deviation event. So it's a 2.5% earnings yield. And you've got a long bond right now, because really people like to focus on the 10-year. You have to compare duration against duration. We'll take the long bond as about 2%. 2% on the long bond, 2.5% earnings yield. And people say valuations don't matter. Of course, they don't matter until they do matter, but the starting point of the multiple acts as either a fundamental tailwind or headwind on expected future returns. The long end of the bond market and the valuations in the stock market are telling you going forward from today, and if we get a big stock market correction or a bear market, or we get a big yield spasm, things might get a lot more interesting, from a yield perspective. But right now, let's talk about what we know instead of providing conjecture. The markets, whether it's stocks or bonds, Larry, are telling you we're in a future of a low return world. That's what it's telling you. We're in a low return world, and you have to adjust accordingly. You surely have to adjust your expectations accordingly. So the 60-40, I don't know if it's 60-40, 70-30, 80-20, 50-50. I have always told my clients that actually bonds will, by definition, always act as a ballast in the portfolio, no matter where interest rates are. And I'm not talking about duration risk. I'm not talking about inflation risk. Of course, those are the risks in the bond market. The reason why government bonds will always be a ballast and never fail to be a ballast is because of their certainty of payment characteristics. And it has to be understood. I don't know what else you'd want to put in there. You want to put gold in, you want to put crypto, whatever alternative assets, you want to put tokens in there. What else do you want to put in there? Agriculture, you want to put in, but all I'm saying is that the only asset that you know what you will get paid in 10 years time with certainty.
Right. Yeah.
Is
No,
the 10-year treasury. So what I'm trying to
agree.
say here is that in the name of diversification, and you want to have something different, like Larry, in your home, I'm sure you don't have the same piece of art all over your living room. You want to have.
It's in every room, David. It's a picture of you. No.
You want to. Well, part of the diversification is to have, assets that will behave differently in different episodes. And there's no doubt that bonds will do better. They won't make you a killing like they did in the past. But if the stock market goes down, if you're 60-40 or whatever it is, it's an insurance policy. Maybe I would just say, so own the VIX, okay? Own something that's inversely correlated with the stock market consistently.
Okay.
And the other thing that I will say that makes government bonds different, and of course, I hear bonds are for losers. Bonds are for losers. You're not going to make everybody. You see, the question really is, Larry, is why is it so important for people today to think they got to make a killing in a few months or in a year? What's happened to this this mentality?
Cryptocurrencies, GameStop,
bonds are not the hare. Bonds are the tortoise. But the most important thing is that there is no other asset class where you have guaranteed certainty of payment 5, 10, 30 years. No other asset class has no capital risk. And by the way, no reinvestment risk. So it's even different than a corporate bond. So what I'm saying is that the risk characteristics, okay? And what I'm saying is that treasuries or government Canadas are purely riskless from a capital preservation standpoint. So I'm not talking about inflation risk. I'm not talking about duration risk. I'm not talking about rate risk. I'm talking about how important is it for you in your portfolio to know that I'm going to buy this and I know what I'm getting paid with 100% certainty 10 years from now. And what makes treasuries different, or government of Canada's, is that certainty of payment does not exist in any other asset class. That's why you always want to own some. Maybe in other times, based on your cyclical view, you want to own more. But if you're ever, you'll have to carry me to my grave to ever say to me, have no bonds in your portfolio.
Okay, so fair enough. If you can't use derivatives or other things to hedge, you can have an option structure on an equity portfolio that actually gives you the same type of experience as a 60-40 portfolio, but still giving you exposure to all equities. So I think the asset class is broken. I think we need alternatives. Private credit is a way to generate a real positive yield after inflation. So I think there's a lot of alternatives, but in the traditional way of thinking about portfolios,
right? But
it's a challenge for the average.
I get it, but there's no such thing as a free lunch, okay? So private credit, fine, but you're going to sacrifice liquidity.
Yes.
So yes, you can't say, oh, you're going to get this. Oh, by the way, it's a free lunch. There's nothing on the other side. Private credit, sure, you're going to get a much higher rate. There is more risk. You're going to get a much higher, and you can lay off some of that risk. You're right, but you are tying up your money, okay, for 3, 5, 7, 10 years. Treasuries not only have that aspect of it of being no capital risk, but there's also perfect liquidity. So, I'm just saying, I know people just look at the yield blindly. It's only 2% or it's only 1% without realizing the other alluring characteristics that help mitigate the downside risks, the capital risks that there are in other parts of the portfolio. That does not change based on where interest rates are. And I would say that this is what I'm actually, and I'm very nervous about the way people talk about their investments today. Okay, I'm very nervous about, you talked about the complacency. I'm finding that the concept of capital preservation, Larry, in the past 18 months has gone the way of the dodo bird. People ask me what keeps me up at night. You want to talk about China? We can talk about China. China's actually that has me very nervous. How China's approach, how it sees itself in the world has changed, admittedly. But I'll tell you, for all the people on the line, that what has me really, really scared is how everybody I know practically in the capital markets have ignored or dismissed completely the concept of capital preservation. And that again, and I don't mean to preach, is such a monumental mistake when it comes to risk management. People have taken risk management, managing their risk in the name of maximizing gross returns in this most bizarre financial market environment. That again has been in the context of the pandemic, which has been great. I guess, Larry, we should have a pandemic every year. Look how rich it's made people.
Well, you would argue though, David, given what's the worst thing that could happen to the world besides nuclear holocaust would be a global pandemic. The world shut down for a couple months, and yet capital markets a year plus later never been higher because of all that support from the government. So what would make you believe that would end sometime, right? So this bubble can keep going.
Yeah, well, and especially, you look at that chart of the negative 10% de facto funds rate, but here's the situation, Larry, is how will that chart change? That chart, you said before, that chart never even got to zero in the last cycle. But we had very big, we had, I think, almost a 20% correction in the summer of 2012. We had another very big correction in 2016. And then remember, in the fourth quarter of 2018, the stock market went down almost 20%. And then we had the Powell pivot. And remember that the 20% decline in the fourth quarter of 2018 happened. That was the year of the Trump tax cut. Who was predicting that? 2018 actually, point to point, was a negative year for the stock market. People tend to forget that. And what happened was that Powell was tightening policy, and it turned out, I guess, to be a mistake. He ended up reversing it in 2019, and that built up even more that the Powell pivot and Powell's got your back. But the reality is that you had a 20% drawdown in the last few months of 2018 without that de facto balance sheet adjusted funds rate ever going above zero. But the contours of that line changed. Let's see how the contours. So the one thing we know is that you don't have to go back to zero for there to be a market correction. We know for a fact that earnings have done very well. Of course, there's this game where we continue to beat estimates that are lowballed. Earnings though sequentially. So earnings is very funny. We look at GDP. Like today's GDP number was not announced on a year-over-year basis. Today's GDP number was quarter-on-quarter at an annual rate. You know what I'm talking about, Larry, was 2% at an annual rate, quarter-on-quarter. But only corporate earnings do we ever report year-on-year. And of course, a year ago, we had very depressed earnings numbers. So earnings are up, say, 38%, and that's all you hear once again on Bubble Vision. But quarter-on-quarter, in the third quarter, when you're looking at seasonally adjusted EPS, we're actually down more than 10%. Like earnings are actually declining sequentially. There's decay already happening. So I think the combination of things are that earnings expectations are going to come down for the coming year at a time when the Fed at the margin is going to be constricting liquidity. And I think those two things, constricting liquidity, even through changing the contours of the shape of the balance sheet, not that it's going to contract, alongside declining earnings expectations, will conspire to create, I think, I'm not going to say a bear market, but I think we're going to have a very big correction in the next 12 months. I'm not going to try and time it. I just know that it's out there, and I know that it's normal. I know it's not normal, Larry, I know it's not normal is the 38.3 CAPE multiple. How comfortable are people out there, irrespective of does the Fed have your back, interest rates, equity risk premium, but how comfortable with you knowing that the multiple, the real multiple is 38.3. How comfortable is anybody here who's long equities? Now, I'm not going to say that there's some sectors that are still attractive and there's parts of the world that are still attractive, but when we talk about the stock market, we're always talking about the S&P 500. A 38.3 multiple is a 3 standard deviation event. That is what you're investing in if you're buying the index right now. And then keep in mind all the money in the index. Now it's going to be interesting to see the coming year between fiscal policy, the midterm election, the change in monetary policy. Look, Larry, you said before that the yield curve is flattening, if not inverting. What does that tell you about the economy? And 15% of the economy is corporate earnings. So I think it's actually the biggest challenge for the markets, or what's priced in right now for earnings for next year. I think that's what's going to come under the knife.
I can't disagree with that one. So my favorite teddy bear in the whole world, Rosie, you're bullish on lots of things. Let's look at the clip that you have on the last page of your daily report. And everybody who hasn't signed up yet should sign up for a free month subscription to Rosie's research. As I said, I've been reading it for 20 plus years now. What do you like here? So where's the value in the world in the equity markets?
Well, look, I think that there's different ways you can look at opportunity. We have a lot of like, I think the Canadian bond market right now looks very attractive. There's a lot of inflation, a lot of Bank Canada now priced in. I actually think the markets really went way too far pricing in what Tiff Macklin was saying. There's a lot. There's, I think, about the central bank that has the most tightening priced in is the Bank Canada. So I think you can buy the money market futures pricing Bank Canada tightening. That I don't think is going to happen. I do, with this backup that we had above 2% and the long bond. I was saying, look, I think bond yields are in a range. Play the range. I like the 10-year above. I like the long bond above 2%. And that's where you're going to get the most juice when they come back down to 1.5%. I'm not saying we're going back to zero, but I do like the long end of the curve right now. In terms of, I guess if you're going to ask me growth over value, I like growth over value. I know that it's very commonplace now. Oh, the value stocks. I'll just say this much. It's called the value trade for a reason. It's a trade. And even in the last cycle, value did outperform growth 20% of the time, but growth outperformed 80% of the time. I just think that notwithstanding the valuations, the really best companies are in the growth proposition. And I'm not just saying in big tech, and big tech is not homogeneous, but I like healthcare a lot. I like healthcare. I like med tech. I think that you want to be screening. You see, this is again where you have to get micro in terms of, it's not so much about sectors. Screen for companies that have high capital labor ratios. Larry made the point before, what if unionization comes back? What if we hit the supply wall on labor? Screen on capital labor ratios. Well, it just so happens that the companies with the best capital labor ratios happen to be in, well, guess what? in technology. And so I would say that you want to screen for, well, let's say that Larry's right about inflation being sticky. Why is it sticky? It's sticky because global supply chains are still impaired. What other reason would there be? There's two reasons why inflation could be, sticky. And I'm not going to disagree with Larry. I'm just saying that we're not going to have a sustained acceleration. I don't think inflation is going to be in our future, but it's going to come from two sources. So supply chain issues. So you want to be investing in companies that are more local than global. Okay. Where do they source their material? Internally or externally. And I said before, screening for capital labor, by the way, we just wrote a whole report on this. Is how do you screen for capital labor ratios? How do you screen for intensity of what companies are less or more reliant on supply chains in Asia? So you can create a whole portfolio that isn't really sector focused, but more actually screening for the sorts of characteristics that we're talking about. I think that, look, I got to say right now that everybody's talking about Bitcoin and all the cryptos, but very quietly, gold and even silver, gold has started to behave quite a bit better. And so I like gold where it is right now. And I think that as the market prices out the Fed after pricing in the Fed, the US dollar is going to go down. So I think you want to own assets that are inversely correlated with the US dollar. But I'd say, look, let's put our global hat on. One country that looks very interesting from a secular growth standpoint, great demographics. It is expensive right now. You'd want to buy it on a pullback is India. The Indian Sensex, pack that away. And I think that notwithstanding the fact that we have a shifting political outlook in Japan is looking very interesting, and India is looking very interesting. And so some of those areas, even Hong Kong might be one of the most inexpensive stock markets in the world. Of course, you got to be a little careful about, the China impact and Evergrande and the property and credit bubble bursting there. Maybe bursting is too strong a word, but that's going to have a ripple effect on Asia. But there's some parts in Asia, I would say Japan and India, that are well worth a look for if you have a global hat on.